In this video, I'm going to talk about companies that pay out dividends and companies that do share buybacks. What will you prefer? And I believe that a lot of listeners who are living in Singapore or in countries where the tax jurisdiction is very favorable, there's no dividend payout, dividend taxes, you'll prefer dividends and income investing. I think it's all the rage, especially in the countries like Asia countries and Singapore. They love that. What about share buybacks? Yeah, how does it work, and whether it's better to have dividends or better to have share buybacks? So take, for example, a company A. It has $100 million of market cap and generates $20 million of net profit. It has 100 million shares, which means that per share, the price is 100 million divided by 100 million is $1 per share. So earnings per share will be $20 million divided by 100 million shares is 20 cents earnings per share. The P ratio will be $1, which is the price per share, divided by the earnings per share, which is 0.2, equals to 5 times. So the company declares a dividend payout of 15 million, okay, out of the 20 million. So that per share will be 15 cents per share. Now, post-dividend, the share price will drop from $1 to 15 cents. There is no increase in value. They merely shifted money from the company to your pocket. And after that, you're back net to the same thing. Net profit minus the dividend, what's left is retained earnings. It goes back to the company. So what's left that the company can use it to reinvest or buy back shares is 5 million. Okay, to be reinvested, right? So for example, if the company has a ROIC or return on investment capital of 20%, that means ROIC stands for net operating profit after tax, divide by the total capital, which is total debt plus total equity. Okay, it actually is a measure of how productive, how much profits they are able to, earnings they are able to generate from that amount of capital. Now, if only 5 million, 15 million is paid out, 5 million is retained. Now imagine the total capital is 100 mil. Okay, same as the market cap. The next year, only 5 million is plowed back to the investment. So it becomes 105 million. At a ROIC of 20% times 105 is 21 million NOPAT next year. So total capital of 100 plus 5 is 105 million total capital, because the retained earnings 5 million goes in. Now 20% growth of 105 is 21 million NOPAT next year. So earnings per share next year will be 21 cents, assuming 100 million shares. Now, if this year EPS is 20 cents, next year is 21 cents, the growth is 5%. Now, a company B, ROIC 20%, doesn't pay any dividend, totally reinvested, able to sustain ROIC of 20%. What happens? 100 plus 20 retained earnings becomes 120. 120 times 20% is 24 million. The earnings per share is now 24 cents versus 20 cents last year. So it's a 20% growth in earnings per share. Why does this matter so much? So case in point to show you, this is S&P 500 with trailing cash flow, free cash flow per share, which is also a representation of earnings per share. And you can see that S&P 500 actually is driven by free cash flow, right? It follows free cash flow per share. The faster the growth, the more capital gains that you have. This is another example, Mercado Libre, and we do a monthly chart. And you can see this is the EPS growth, diluted. This is the free cash flow. It is rising. As long as it continues to rise, the share price follows. This is FICO, Fire Isaac. It's a credit scoring company. And you can see that it is rising. The share price is going up and the free cash flow is going up. In fact, it's in lockstep and very highly correlated to earnings per share growth. So these are signs that obviously you want a company that grows as fast as possible to achieve that best possible return. Coming back to here, Now, if a company pays you 15 million out of the 20 million net profit, the question is, what is it signaling? If it's able to produce a ROIC of 20%, that means reinvesting it can produce 20% return, and the earnings per share can jump by a 20% growth in share price. Instead of paying you out that 15 million, okay, which is about 75% of their net profit, and only achieve 5% growth, it is actually indicating that they don't know what to do with the money. They cannot achieve more than 20%, and it's better to return to you the funds. Now, if you are in a country where there is no dividend tax and no capital gains tax, why would you want to depend on them to get paid? Because you can, I would rather make 20% growth in the stock market. Okay. Now let's go through the calculations. Company B, ROIC, no dividends. 20% ROIC. The capital for company that pays out 75% of the earnings, 100 plus $5 reinvested becomes 105 times 20% is 100. 20% times 105 next year becomes 21 million net profit. Okay. Earnings per share would have been 0.21 in the year 2. So 20 cents this year, next year is 21 cents. The growth is only 5% because they pay out most of it. Couldn't reinvest. Company B, ROIC 20%, no dividend. Everything is reinvested. Okay, the capital becomes 120. Okay, that will generate at 20% ROIC is 20% times 120 now become 24 mil. EPS will have grown to 24 cents. 24 cents divided by 0.2. Okay, that was last year. The increase is now 20%. Now you compare the total shareholder return. For company A, you receive 15 cents per share, and then you get a 5% capital gains. 5 cents capital gains. Okay, that's about 20 cents worth to you, which is 20% return. So company A share price is now 105 at the end of 1 year. Okay, because there's 5 cents reinvested. Year 2, 15.75%, 15.75 cents dividend paid, slightly increased because the earnings is now 21 mil, right? At 20% ROIC, 5.25% increase in share price because earnings per share is up. Okay, now 21 equals to 21 cents total return in year 2, right? So the share price now is 1.11. Okay, total shareholder return at the end of 2 years is 10.5% of capital gains because now the share price has gone up to from $1 per share to become 1.105. Okay, it's about 11%. Capital gains, okay, and 15% plus 15, 2 years of dividend, total return is 41.25%. Whereas company B, 20% growth year 1. Okay, share price will jump to 20 cents, 120. Year 2, 120 times 1.2, 20% growth is 44, 1.44. Share price 1.44. Total return 44% is superior to this. And this difference is magnified. If I were to put the ROIC of a company at 40%, the difference will magnify, and if it compounds year and year. So you can see that a company pays you dividend in your pocket actually slows down the growth. That's why when company have a payout ratio of over 50%, I worry because there's no chance to reinvest. So I will say that if you are, even if you're in a country where there is no dividend tax and there's capital gains tax, maybe it makes sense to buy some stocks that are dividend payout. Okay, but if in a country where there's dividend tax is higher than the capital gains tax, it doesn't make sense. So especially in a country where there's no dividend tax and no capital gains tax, it pays to control your own cash flow. I rather make money from capital gains to pay you as and when I need the money. I take it as a dividend, which is actually a profit. I would rather make money from capital gains and control when I need the cash flow. Now, if a company has a payout ratio of 75%, no PAT is 20 million, 5 million retained earnings because they pay everything out through, most of it through dividends. After 10 years, we only have 50 millions of retained earnings. What happens if the business has some cyber security hacks like Evolution AB? Because they have signaled that they are paying so much, they have consistently paid out 50% of their dividends, and then how they're going to retain the money to reinvest into cybersecurity to spruce out to prevent hacking. And this reinvestment, when you have a signaling that the payout is very stiff and always consistently 50 to 60%, you have a problem. Okay, you cannot have the flexibility to reinvest, whereas a payout ratio of 0, for example, you don't pay consistent dividend. So you have no PAT of 20 million. After 10 years, you have achieved 200 million of retained earnings. You can do a lot of things. You can use that to do share buybacks when the company is down, the share price is down. You can use that to reinvest, or you can pay a special dividend. So say a company that consistently pay out, this is Evolution AB, they pay out about 50 to 60% every year. Okay, and they have consistently signaled to the investor that they are paying out this amount. It goes up every year. Where is the flexibility? Only half of the money is being retained. Now, if you ask these companies that actually pay out consistently and ever increasing dividend, the moment they cut their dividends, the share price is going to plunge even further. They are being tight. You could say that they're wearing a tight jacket, right? You can't tell them I need to reinvest because the company investors that they attract naturally depend on their dividend. And once you signal that there's a drop, the share price will collapse. It could be pension funds, it could be insurance companies, it could be retirees. And these companies simply don't have the flexibility. Now let's look at the impact of share buybacks. Now, if a company has net profit of 10 million, market cap of 100 million, number of shares 100 million, net asset is also 100 million. Okay, earnings per share is 10 million divided by the number of shares is 10 cents, share price is $1, P ratio is 10 times, net asset per share is $1. Share price, if it drops to 50 cents, P ratio will have dropped to 5 times. Now, if the company's management is a great capital allocator, it buys back 10 million shares at that time because it's cheap. And because it thinks that it's worth 10 times P. So buy back 10 million shares for 5 million at 50 cents per share, share count will drop to 90 million. Now let's look at the net asset. 100 million of net asset minus 5 million of cash, because cash is being used to buy back shares. Net asset becomes 95 billion. Net asset per share 95 divided by 95 million divided by 90 million shares is 1.056. By virtue of buying back shares as a minority shareholder, as a passive shareholder, you actually see an increase. So what would you rather have? A dividend in your pocket or company that buy back shares? In fact, one of the biggest indicator of whether the company has is favorable to minority shareholder is the amount of share buybacks that they make. And the share buybacks must be more than the stock-based compensation. Okay, so do not just look at share buyback. You must deduct stock-based compensation against it, and net it must be positive. And a great capital allocator buys back shares at a time when the share price is cheap. Now let's look at some evidence. So let me give you an example. First is AutoZone. These are called cannibal stocks, right? Companies that buy back their own shares. You can boost your earnings per share simply by doing share buybacks, even though there's zero growth, as we've seen in example. So AutoZone, this is the buyback yield, the amount of shares that they buy back over time, and this is 2.55%. But notice when the share price is down, this is where they increase their buyback. And these are example of a great allocator. 11% of the shares is bought back. Okay, buyback ratios go up over time. And when it's expensive, they reduce their share buybacks. So you can see that the share count time has declined over here. from is 69.84 million to 17.245 billion. In fact, 85% of the shares are gone over the 20 years. Next example. This is Apple. The share count has declined since the peak 2014 from 26.087 billion. Today is 15.005 billion. Close to 42% of the shares have disappeared in the last 10 years, have been bought back. And more importantly, look at the buyback yield. It spikes whenever the share price is low. It spikes whenever the share price has come down. Next is Google. Alphabet. The share count has declined from 14 over the last 8 years, 14.072 billion, now 12.447 billion. The decline is roughly about 13%, but as with great capital allocators, when the share price is down, the buyback yield actually spikes to 5.79%. So this is one of those example of share buybacks, how it adds value. So to be honest, when a company pays out a lot of dividend, the time where they need to reinvest in the capital, they don't have no money. So the only way is, one, they increase their debt, which actually raises the risk of the company. Number two, they dilute you, and they always dilute you at a high, because that's where the share price is expensive. We want to dilute a company at 10 times PE, okay, when the fair value is 20 times. So they rather wait till 30 times PE and then they dilute you and issue new shares. So dilution actually it takes away your money, okay? Increasing debt also takes away the money. So share buybacks are important. And to conclude, the more dividends they pay out, the less retained earnings. And if your ROIC is very high, 20, 30, 40%, the difference will be a lot more. So you have the flexibility. I would rather that you invest, and then when you need cash, liquidate your capital gains as in lieu of dividend. Thereby you control your cash flow. Yeah.